everyone. Welcome back to the Mason & Associates YouTube channel. I'm John Mason, Certified Financial Planner and President of Mason & Associates. Mason & Associates is a financial planning firm with a unique specialty serving federal employees not only in our local environment in Virginia, but throughout the country. So welcome back. If you missed the first episode of this mini-series, what we're talking about is avoiding the common financial planning mistakes made by federal employees. So there were two big takeaways from episode 1, which that'll be linked in this video. But one takeaway is you are very special. So I want you to try this where I know we just listened maybe to that previous episode, but let's do this. When I say you are very, I need you to say special, okay? You are very special. And the reason that you're special is because you have something that the rest of America doesn't have, and that's called a defined benefit pension. And an even smaller portion of the people that have a pension have one that's cost of living adjusted. You as federal employees have both, so you are special. And remember the other takeaway from episode 1, they are not talking to you. The media financial planner, your next door neighbor, the water cooler financial planner, unless they specialize and have the knowledge like we do, serving federal employees and your complex benefits, the advice that you're hearing on CNBC, the advice you're hearing from other folks is general advice. It's advice that is geared towards people that don't have pensions, that don't have federal employee health benefits. So we implore you, the next time you hear a piece of financial planning advice, just step back for 1 second and think, does this apply to me as a federal employee? And we would wager it does not. So remember, this is avoiding the common financial planning mistakes made by federal employees. We've been presenting this seminar for decades in our local market, and we wanted to bring it to you here on YouTube. If you like what you see, please subscribe to our channel, please like this video, and if you have questions or comments or fears, things that keep you up at night, drop those down in the comments and we'll respond to those and shoot a future episode here addressing those as best we can and as timely as we can. Now, we are financial planners first. Our primary focus every single day is serving our clients who have trusted us to do their investment management, their tax plan, and their financial plan. We do this second. Our podcast, Federal Employee Financial Planning Podcast, this YouTube channel, and our local presentations, that's second to our core competency, which is serving folks just like you. If you'd like to become a client, you can do that at masonllc.net, and you can request a no-obligation phone call with one of the advisors on our team, 15 to 30 minutes. Our commitment to you is you'll be better off after that call than you were beforehand. So let's dive right in, avoiding those common financial planning mistakes made by federal employees. Well, if we divide this out and we really think like, what type of categories are we going to cover in this presentation? We're going to cover your largest asset. We're going to cover things like survivor benefits, thrift savings plan, FEGLI. We may even touch on some Social Security. So throughout this mini-series, we're going to go through all of these topics. Today, we're going to cover just a few in this video. Before we can start talking about the mistakes, let's make sure we know how to calculate your FERS pension. Now, if you're CSRS and you're watching this video, we'll do a separate video specifically talking about how we calculate a CSRS pension. But in the video, our examples for today are specifically just going to address the federal employee retirement system. So, how does FERS work? Well, FERS is a three-legged stool, and you've probably seen that. If you've looked on YouTube, there are other folks out there that do federal employee financial planning, and they talk about the three-legged stool, and we do too. Part 1 is your pension, Part 2 is your Social Security, and Part 3 is your thrift savings plan. Those three together generate your retirement income as a retired federal employee, so it's a three-part stool. Civil service, CSRS folks, you have two. You have your CSRS pension and your TSP. You do not have Social Security. What does the rest of America have? The rest of America has Social Security and what they've saved. So this federal employee pension, remember, that's what sets you apart from everybody. That's what makes you special. That's why the advice that you're hearing does not apply to you. Now, in our example for this video, we're going to assume a $100,000 salary. So you're a federal employee, 30-year career, and you earn $100,000. Now, we know that not every federal employee earns $100,000 a year, but the reason we use $100,000 is it makes our math really easy. So if you're watching this and your salary is $50,000, you can take most of these numbers and divide them by 2, and we're going to arrive at a similar place. So how does the FERS pension work? Well, before we talk about that, let's talk about Social Security actually. So if I have a $100,000 salary, the first 6.2% of my pay goes into Social Security. As you can see on the video here, 6.2% goes in, not only just for me, but also my employer is kicking that in. And at the end of the 30-year career, let's say we have an estimated benefit of about $24,000. So I paid in 6.2% of my pay, $6,200 a year. And at the end of that 30-year career, about $24,000 in benefits we would receive. Part 2 of your retirement income is going to be your FERS pension. Now, folks, if you didn't know you had a pension, you wouldn't be the first federal employee that didn't know you had a pension. Unfortunately, there are federal employees out there thinking that they have to retire on Social Security and TSP alone. And worse, there are financial planners counseling these folks that aren't even talking about the pension. I think about one story, one of my favorite clients for over a decade now. His financial planner before us kept telling him that his plan was going to fail. It kept telling him, you're not going to make it, you have to save more. Well, when I looked at the financial plan, what asset was not on that balance sheet? What income stream wasn't going into the cash flows? It was his FERS pension. And because that financial planner didn't know about the pension, this family spent a number of years thinking that they were never going to make it. That is unfair, not good advice. Luckily, we were able to swoop in and kind of make that a little bit better for our friends and our clients now. So, FERS pension. If you are under the original FERS, that is the FERS system that was created in 1984, and then I think fully released in like 1986 or 7, those folks pay 0.8% into their pension, and at the end of a 30-year career, they will have a pension amount. How does FERS work? Well, for every year of service, you earn 1%. So if you've worked 30 years, you've earned a 30% pension. The second component is your high 3. Your high 3 is your highest 36 months of consecutive earnings. That highest 36 months can be at the beginning, middle, or end of your career. Now, for most of you, that will be the end of your career, but it could be anywhere in there. We have clients who have taken a temporary job in Washington, D.C. mid-career and established their high 3 and then moved back down to Hampton Roads at a lower pay, but we were able to lock in that high 3 when they were up in D.C. So how many years did you work? Every year you earn 1%. Times your high 3. Well, in this example, remember we're using $100,000. So in this example, that federal employee pension is $30,000 per year. Many of you may have heard of the age 62 kicker. What happens is if you were to fast forward to age 62, every year actually counts for 1.1%. So it's like a 10% bump on your entire retirement by making it 20 years in age 62. So, example, you'll see here, look at this. You pay in 0.8% of your pay. That's $800 a year. $800 goes into the federal employee retirement system. And at the end of the career, you have replaced $30,000 pension coming in. So we have our $24,000 Social Security, and now for $800 a year, we have produced another $30,000 of income. Folks, we all know Social Security is going what? Most people think it's going broke. Most people think there's issues. Most people think that there are problems, and we need to solve those problems. We would submit to you that we think Social Security is going to be here, but there will be changes coming, in addition to the changes that have already happened over the last several years. But look, if Social Security has a problem, how about federal employee retirement system? For 0.8% of your pay, we're replacing 30% cost of living adjusted for the rest of your life. So that's the first 2 parts of your retirement income. Part 3 is your thrift savings plan. Now, folks, in this example, we didn't do a ton of present value, future value calculations, but let's just say you save 10% of your pay. That's $10,000 a year going into your thrift savings plan. As a federal employee under FERS, you receive a 5% match. Some of that is a gimme, and other of that is actually matching money. Okay, so if you put in 10, the government's going to put in an additional 5. So you're contributing $15,000 a year to your thrift savings plan. At the end of that 30-year career, it's reasonable to expect about $18,000 to $20,000 of additional income if we invested appropriately and save that money over our career. So if we total all of this together, we've got $24,000 coming in from Social Security, $30,000 coming in from FERS, and $18,000 coming in from Thrift Savings Plan. So that's $72,000 per year of income, or 72% income replacement. And folks, we set aside 17% of our pay to get those benefits. We would like to introduce you right now to a concept called modified current income. Modified current income is the way that we like to show our clients that they're able to retire. And here's how it works. You may have heard the old rule. If you can replace 70% of your pay, then you can retire. Living on less in retirement is not what we're hoping for. What we want to know as clients walking into retirement is that we're going to have 100% income replacement. The problem is many people don't know how much money they're making. So introduce modified current income. Take the income that you're making today and subtract off those expenses that you have today that you won't have in retirement. So if we just look at this example of what you are contributing to retirement, you're not living on 100%. At best, you're living on 83%. And if that 83% doesn't get you home, one way to get closer is to save a little bit more. That lowers your modified current income, it lowers your retirement need, and at the same time, it boosts your retirement income because we're going to have more disposable income and things like thrift savings plans, IRAs, and Roth IRAs. So as we get close to wrapping up this video, we want to compare federal employee retirement system to somebody in the private sector. Because remember, two big takeaways: you're very special and they're not talking to you. So let's compare you to somebody in the private sector. And as you can see on the screen here, if I'm private sector making $100,000 per year, I'm going to pay in 6.2% of my pay into Social Security as well. And I'm going to receive the identical benefit that you do. Let's assume my 401k or TSP or 403b has similar generous matching money. Well, it's reasonable to assume that if you save 10% and I save 10%, both of us are going to have about $18,000 a year of retirement income. What's the difference? What's missing from my retirement income? Well, because I didn't have the ability to put $800 per year, because I didn't have the ability to put $800 a year into a pension, my income is $42,000 a year in retirement compared to your $72,000. So for $800 a year, you beat me by $30,000 a year cost of living adjusted for the rest of your life. And then when we start layering in survivor benefits, that kicks in for your surviving spouse. Folks, this is not sour grapes. This is not a video to disparage federal employees. It's a video to help you understand the power of your benefits and why they're so lucrative compared to what most of America is retiring on today. $800 less per year went in. That's it. And you have $30,000 more retirement income for the rest of time. This sets you apart from the rest of us. It sets you apart from the private sector. And at Mason & Associates, we hope through this education on this channel, as well as our clients, that we're able to pass this along, because what we want to do is not just continue to tell you how special you are. We want to empower you and motivate you to do the things that you should be or could be doing in retirement. What do I mean by that? If you know how good retirement can be, you can start planning more trips. If you know how good retirement can be, maybe those last few years of while you're working, you could actually reduce what you're saving into Thrift Savings Plan and do some of those home projects a little bit earlier. Maybe we can spend more time on vacation, 2 weeks instead of a single week. So we hope just to put this into perspective to empower you to make really educated and informed decisions that not only about your benefits, but your overall financial plan. Thanks for joining us on the channel. We'll be back soon with the next episode of Avoid the Common Mistakes Made by Federal Employees.